The show is brought to you by Strathmore Center for Value Investing. And this is special because it is our maiden show. Are you happy? And we're going to be having East African Breweries Limited as our first company to analyze its performance. In the audience, we have faculty and students pursuing different degree programs. And as part of the academic journey, they're supposed to carry out financial analysis and modeling of companies, trying to figure out the nexus between business strategy and performance. So today we are honored and privileged to have the Chief Finance Officer, CFO of East African Breweries Limited, Rispa Ohaga. A round of applause for her. So we go way back with her. She was my senior when I was working at KPMG, so I don't want to introduce her. I want her to introduce herself. So my name is Dan Chirchir. I'll be your moderator today, and we hope that we can be able to help investors and our capital markets to develop further. So I'll give this time to Rispa to introduce herself before we proceed.
Thank you. You can hear me? And thank you, everybody, for coming. My name is Rispa Ohaga, old-time student of Strathmore. I was saying I was the second cohort into this campus on the other side, so it's always great to be back here. I work at EABL as the group CFO. I started my career at KPMG, where I was in charge of Dan. Now I call him Professor. But yeah, that's where I started my career. I spent 9 years there doing audit, largely financial services, but also other areas of consultancy and internal audit. And then I moved into Barclays to head internal audit for East and West Africa. Did that for 3 years, moved to South Africa with Barclays to head audit for Africa. And then after 3 years, actually 4 years, moved into finance. And after a year on a project in Mozambique, was appointed as the CFO for the Zambian business for Barclays. I spent 4 years there, and thereafter I came back to Kenya into the role of CFO at EABL. So I had a breadth of experience from audit and consultancy, as well as manufacturing and banking. Yeah.
Thank you so much for gracing this occasion. Now, when you hear the term CFO, a lot of things come into mind, one of which is this is a C-suite position at the very top of the corporate hierarchy. But what exactly are the strategic roles of a CFO in any organization?
So the way I think about it is that the CFO has 5 major hats, if you like. And the first hat is that you're a custodian of the business. If you think about it in old terms, you're the one who keeps the keys to the safe, and you keep the assets safe. So that's the first role of the CFO. You may not do it directly yourself on a day-to-day basis, but it's absolutely critical for your role. The second role is an operator, which is what really is financial control types rule, payments, order to cash. Again, operational processes that you may delegate within the organization, but again, they fall at your doorstep, because that's what we report in the financial statements. If that doesn't work, then the reliability of those financial statements come into question. So you have to make sure the operational pieces are working. The third thing you have to do, which now starts to get a bit strategic, is that you're a leader. You're a leader of finance, but you're also an organizational leader. So what are your values, your behaviors? Are you a role model in terms of the way you conduct yourself? Do you inspire people? Are you coaching? Are you mentoring? Are you motivating? And are you leading people to success? The fourth role is driver, and this is where you'll spend most of your time. because you're driving a business. You co-own the strategy with the managing director, and then you now drive performance. Once you commit to budgets, so you commit to the market, yours is to make sure you're pulling all the growth levers, all the performance drivers, and you're delivering performance. So very critical that you're shaping, driving the business, regardless of what's happening around you. And finally, you're a financier or a fundraiser. You explore the market for funding to run the business. So that involves working with banks, with capital markets, with investors, analysts. So that's also a piece of a strategic piece, because you have to think about how are you going to fund your strategy. So that's why I think about the role of the CFO. Some roles are more operational, but if they go wrong, I always say that's what gets you in jail. So you have to think about those aspects in as much as you're not involved in the day-to-day. You have to make sure you've got structures, you've got process, you've got controls that enable you then to operate at the strategic level.
Thank you so much for that. If you don't mind, just paint a picture of a typical day in office for you once you show up in the morning.
I thought about it and I said, I don't know throughout my career if I've ever had a typical day. Every day is different from one day to the next. It varies, and I do enjoy the variety. I don't like monotony. So from day to day, you're dealing with different things. Today, for instance, was performance day. So I'm meeting with all the different businesses, looking at how they're performing. Are we delivering our commitments? What are the things that are standing in our way? What are the things that they need unlocks to deliver? And therefore, how is our business going to perform? What does our outlook look like? So today is one of those days where I'm going to spend a lot of time on performance. Later, I'm going to meet, I have a new audit partner, so that's who I'm going to meet. Yesterday was completely different. I was dealing with a detailed deep dive into one of our business that needs a funding solution, also needs some unlocks to deliver what they need to deliver. So there will be days like those. The days when I spend time with investors, analysts, the days when I spend time with people, the days when I'm external, the days I'm with the bankers. So depending on which heart is calling the most, then you will find that I am quite engaged in a variety of different activities as I navigate the 5 different hearts of the CFO.
Excellent. So we want now to go into the historical financial performance of EABL. And we're going to start at the top line, which is the revenue. I saw a 27% increase in 2022, 0% in 2023, and then a 13% increase in 2024. So what explains that revenue trend, and what are the key revenue drivers?
So let me first start by saying, our revenue at the end of June 2024 sits at 124 billion. That's across the 3 countries. Absolutely right, that is 13% on the other year, on the previous year, F23, and F22 was actually really, really strong as well. Our business, as you know, and if you live particularly in Kenya, is very much driven by what goes on around us. If you think about F22, we were straight out of COVID, where there was a lot of bar closures, there was a lot of disruption to the economy, and so there's an element to which there was pipe fill from all of the closures. Businesses had gone down, so they're only starting to come back up. So in F22, we experienced that return from COVID, which saw beer grew about 22%. So the beer volume growth was great. You'll see that in the margins. It helps your fixed cost absorption, and so that showed up in the F22 year. If you remember F23, in the second half of the year was the year we had salaries delayed by government and not paid for a number of months. We had demonstrations, a lot of them quite disruptive in terms of moving product, in terms of people just carrying on with their normal lives. At the same time, you had the geopolitical issues post-COVID, some of the issues around Russia and Ukraine, and the attendant inflation. So you started to see consumers take a beating and having less available to spend spend and their share of wallet that was available for our products was reduced, and therefore you saw a drop in consumption, a drop in volumes. At the same time, that's the year we had 2 excise increases. You had increase in June, and then you had another increase in October, and all of that really has an impact on people's ability to afford the different products, not just our products. So you see that F23 was a particularly challenging year. Coming into F24, we've gotten some reprieve coming out of the drought. The drought in that previous year also, so inputs were scarce. You could not find enough sorghum, ethanol, so you were really, really struggling to get those. You were having to import a lot more of product that we didn't have to import before. We could find that locally. So F23 was particularly disruptive from a macro perspective, and businesses operate in a macro, so you will see that coming through the numbers. So coming into F24, a lot more stability, particularly in Kenya. We saw volume growth coming through. There was a stay on excise by government. That makes a big difference. The way we like to tell them is that salaries catch up with inflation only after 2 years. So if you increase excise every year, then salaries are not catching up with the cost of goods. And so I think finally we were hard, and the annual inflationary increase was not put through, and that helped us to recover, particularly beer volumes, and total volumes grew by just about 1%, but given the declines in the previous years, that was quite a positive outcome. So F24, a resurgence, some challenges still in some of the markets, but certainly a huge improvement in Kenya. In particular, we grew revenue about 13%, so that was really good for us. Yeah, so you operate in an economy, and you have to navigate the economy to deliver results.
Excellent. Yeah. And that takes me to the gross profit margins. I saw a very stable GP margin of 43% over the 4 years, save for 2022, where it was about 48%. I'm just curious, how do you stabilize that particular GP margin despite the inflationary environment and also the tax concerns?
It's a tough one. It's a mix of, I should also have mentioned that in F24, we did take price to cover inflation. F24 and F23, there was quite a lot of price. So you'll see 13% revenue growth, only 1% is volume, so 12% is price. And to some extent, you need to manage that because consistently increasing price then starts to impact volume and affordability. So it's always been a tight balance through COVID. But just coming back to gross margin, we do a number of different things. You have to play the different levels of your business to be able to get the right results, and sustaining gross margin is very important for us. So in the face of inflation, as we experienced in F23, we really work hard on what we call productivity. Every single year we have a target of productivity. We say this item cost you 5 shillings last year. With 6% inflation, it should cost you 6 shillings, but we want you to hold it constant, or to only have it's coming up to 5.5. So we set ourselves a target to say we're going to manage our cost down. And so we take on a lot of projects, not just on the input side. The sourcing side is a big part, but also how we use resources, reduce wastage, more efficiency, look at packaging, look at formats. Sometimes you'll notice simple things like, I have a front and back label, do I need both? Can I take one out? And small things like those make a difference. So really looking at efficiency in our businesses helps us to cushion the impact of inflation. The other aspect of that is to take price, because if you're being hit by inflation, if you don't take price, then you keep on eroding your margins. So we have to balance that carefully so that we don't outprice, but that we keep margins constant. Finally, the last thing is when you see variations like in F22, a big volume means better fixed cost absorption. So we have a plant, and I tell people our plant, the new plant we built in Kisumu, was about 15, 16 billion shillings. you can't fold it and put it away when there's COVID. It's there to stay. And so your best option is to utilize it to produce goods that you can sell. So the more you produce, the less the cost per unit, the more profitable you are. And that's the conversation we also have with the regulators. Say the more you tax, the less the units, the less people can afford, the less tax. So in a good year, more production means better absorption, means better gross margins.
Thank you so much for that. So let's shift gears to the bottom line, which is the net profit. Of course, EABL continues to post record profits in billions, Kenya shillings. But I saw a downward trend over the last 3 years. So what explains that?
Yeah, the last 2 years, again, if you're living in Kenya, you know we've been hit by two major things. First is FX. We've seen the Kenya shilling take a beating. In, I think, F23, it was about 13% depreciation. In our F24, it's about 22% depreciation. So the combination of that in a year in particularly where we were importing a lot more inputs because the drought meant that you couldn't access some of the local inputs, you take a beating from an FX loss perspective. So you'll see before you get to FX losses, our operating profit before interest and before FX losses is actually growing. But when you put in the FX losses and the second element, which is interest, if I look at the T-bill in back in F20, it was about 9%. That was the 182 T-bill. In F23, it came up to 12.9%. Now it's sitting at 16. Yeah, so you can see that immediately if you have big plant which you have financed, you've come from a 9% base cost to 16%, you've doubled your funding cost. So those two take a big impact on the bottom line. However, you will see that we paid down about 11 billion in debt to mitigate some of that impact of the rising interest rates. So those two, not just unique to us, but across manufacturing industry, we've really taken a lot of pain from FX and from interest costs. Where do we see positivity? The currency stabilizing in Kenya has been good for us. Uganda has been largely stable, but we're seeing some sliding in the last 3 months. And Tanzania is the new kid on the block that's taking a lot of pain from a currency depreciation and liquidity perspective, where even if I wanted to pay, I can't find currency to use to pay for product. So balancing the portfolio means that something's always happening in in one country or the other. So we're okay from a Kenya perspective, but it means every shilling you make in Tanzania is 20% less than what you were making last year because their currency has weakened against KES. Yeah. Now
that you've talked about the cost of debt, I think it's the right time now to go to your capital structure. I see a debt to total capital ratio of about 60 to 70%, depending on the year. What is the rationale of having such a capital structure?
So I think the way I think about capital structure is how do I fund the business? And what's the most efficient way for me to fund the business? And every year we work on our capital structure, we look at the strategy and we say, how do we finance this business and what are the sources? And you sit and look at all the sources. I can borrow from the majority shareholder. I can borrow from the market. I can do that in local currency, foreign currency. I can go to the capital markets. So I look at all the different sources of funding and consider which one is appropriate. Now, you find that debt generally is cheaper than equity, but also quicker to work with. Because to do an equity raise is quite a big project, to which there are no guarantees. So I think we're quite comfortable, and when I looked at comparator companies in the same industry, our industry is capital intensive, so you will generally be funding your long-term capex with debt. And a lot of them are operating between 50-60%. Our parent company is at about 65%. ABI is also about 55%. So it does seem to be well within the norm for a business such as us that is capital intensive, but also highly cash generating.
So if I hear you correctly, then you're not rethinking your capital structure. So you take a view that whatever is happening currently is just transitory?
Yeah, and also if you bear in mind that we've really paid down a lot of that, and also we have paid dividends so that you are giving back to the shareholders some of their equity. I could retain, there was a year we retained, and even F23 we paid a smaller dividend again to protect the company's liquidity. So I would say it's a thing you look at every year and ask yourself, is it still optimal? At the moment we feel it's optimal, though we want to come down on debt for obvious reasons. Yeah.
I think on the last section for me is shareholder engagement. If you look at EABL, it's listed. We have equity investors, we have MTN investors. And if I look at a typical investor, their portfolio, there's very little equity in the portfolio. But as a center, we want to encourage Kenyans to invest in the stock market. We're sure the preferred asset class for them, I'm sure it is land, but we want them to go to the equity market. Having said that, how do you engage your shareholders?
So quite a lot. In the first instance, I have an investor relations team, which we've invested in over the last 4 years, saying we need somebody dedicated around investors. And we have foreign and we have local. So we have a program in which we speak with them every quarter. We give them updates on our progress so that they can hear what's happening with us. So we do that both with local and foreign investors. We do that again when we do our results at half year and at full year. So there's quite a lot of engagement. We do have a major shareholder that holds about 65%. They get a lot more updates because they are really quite closely involved. But we spend a lot of time making sure we are reaching out to the minorities through calls. We put out materials on our website. We put out newsletters, just giving a lot more detail on what the company is doing. So that's how we approach it. We haven't done any big road shows or workshops at the moment. We did a road show when we were doing the MTN, and we reach out quite regularly to speak to the MTN holders. Again, just giving them comfort that the company is solid, that we are in a position to continue to repay their interest as well as their capital. Yeah.
Thank you so much, and that brings us to the end of the first session with her, so we might clap for her. So now we are moving to the Q&A session, and we're going to be inviting you to ask questions. Just raise your hand, and then when you get the mic, please start with your name, what you do, the degree program that you're pursuing, and then you can pose your question. So the floor is open. You can raise your hand if you have any question for her, and we'll get you the mic. Anyone?
Hello?
Yeah, there's somebody at the back.
Yes, thank you. My name is Matthew Njoroge. I am doing financial economics. I'm in my second year. So my question is, if you check the NSE, on a book value basis, most of the companies are undervalued if you look at the price to book value ratio. But in companies such as Safaricom, let's say EABL, and a few other companies, they're above one. And maybe we could say some of these companies are government. The government is a huge shareholder. For example, Safaricom, the banks, equity, not equity, like such KCB and such. And EABL, obviously, the majority shareholder would be Diageo. So when you look at that stat, is it more of an issue of lack of capital from retail investors? Is it a contrast in how people view the companies that are overvalued compared to the ones that are undervalued? Is it brand name? Is it prospects of future earnings? What do you think leads to that? Thank you.
Thank you. We've done quite a lot of studies to try and understand how our stock market operates. And yeah, let's just say it still remains a mystery. But having said that, the general consensus is even EABL is undervalued. When we look at PE ratios and where we're trading, the share price doesn't reflect the value of the company. And that's, a given. And if you look at when Diageo came in to buy another 15%, they were offering 192. The people cashed in at 192, now it's sitting somewhere at 152 or thereabouts. So generally, it is, you will find that most of the stocks are undervalued. The reason for that is varied, but I would hazard, one of the views I have, is that if you can go and get a T-bill at 16%, why are you going to go to the stock market, right? So the fact that our rates are so high compared to markets where interest rates from government securities are in single digits, then you'll find more activity on the stock market. As long as that disconnect happens, then it's very difficult to attract funding to the stock exchange, and we see that quite a bit. So that's one. The second bit, yes, there's an element to which the name, the reputation counts, but I think generally that challenge around also liquidity is part of the issue, that if I come in and I buy shares, if when I want to get out, I can't find a buyer because there's just no movement, then very few people want to risk that. So I think there's still a lot more to be done to make sure that, one, there's activity on the stock market, two, the stock market and equities are as attractive or more attractive than debt, and particularly government debt. And when that happens, then you'll see that unlock. But I think there's still a lot of good opportunity. There's good pickings. If you check quite a bit, there are a lot of stocks that are undervalued. And if you think about it long term, then most people also think about these things short term, but equities are long term plays. So you need to think about the long term potential of that company and its potential to generate dividends as well as share improvements. So you have to look at it from a total shareholder returns perspective. So is our market efficient? Not in my view. It doesn't ever respond to sentiment or to real performance. But I think with a lot more education, activity, liquidity, we should be able to see a lot more going on in the stock exchange.
Thank you for that. Any other question? Yeah, so there's a question on this side.
Hello, hi. My name is Preston. I'm doing financial engineering. I'm in my second year. So my question is, what are the biggest challenges that EABL faces in maintaining a competitive edge in the market? Because we learn theoretically about some of the biggest challenges, such as regulatory compliances and intense competition, but practically speaking, in practical terms, what are the main challenges you face as a company? Thank you.
Thank you. I think always number one for us is regulation, and particularly tax policy. And you can see that when I talked about our numbers, when you see successive increases in tax, then you can see the impact on the top line. We are taxed about 60% higher than Uganda, and just almost the same as Tanzania. So our tax regime takes us out of competitiveness. And that's why if you go to the border towns, you see beer crossing, because it's way cheaper, and it's cheaper because of tax. The second thing about tax is not just about paying it, because when you do pay, and it is reasonable and isn't impacting affordability and the volumes grew, then a lot more tax will be collected. But it's also predictability. You've got years when you've had 2 increases, the years when you've had an annual increase. You just don't know when it's going to happen to you. And if you're investing in a plant that's several billion worth, you need some certainty as to how the tax environment will be operating. Otherwise, you just have those fluctuations in performance. So for us, we spend a lot of time in policy trying to do studies that will help government understand the impact of policy and making sure that we're doing the right thing. It's not that we don't want to pay tax, but when tax is destructive for business, then it becomes quite challenging. So we help them, the policymakers, knowing they're between a rock and a hard place, to make the right decisions to grow industry so that jobs can grow. So number one for us is always tax policy, and it's across all 3 markets. The number 2 thing for us is we have to stay very much close to our consumers. Consumers are diverse, they're changing, they have different needs. We're seeing different trends coming in, people wanting lower alcohol products, people wanting things that taste nicer than your old school beer. So really staying close to our consumers. And one of the things that we've done recently in the last 2 years is to invest in a microbrewery. The microbrewery allows us to test and learn a lot more. So we are producing introducing a lot more new products. Some of you will have seen Manyata, Taskandimu, Pineapple Punch. So we're experimenting a lot with different things, moving very quickly to land them. If it works, and we scale it up into the big plant. If it doesn't, we then take it out. So that's a big one. The third thing is just the macros. The macros, again, as I said, macros impact disposable income. And for a product that's not mandatory, if disposable incomes are pressured, then you'll find people dropping off as well. And finally, linked to that is illicit product. I think in our country, you've seen people mix up whatever they can find and sell it. And that is about 50% of the market. 50% of alcohol drunk in Kenya is not legit alcohol. And therefore, the taxing of alcohol at a very high level, it doesn't mean people stop drinking. They just drop into illicit and drink the bad stuff and government taxes. So that's also a big one for us to make sure that we're working with government to solution for people not to get into that sector. There's a lot more other risks. I think I have a list of 13, but I think I'll stop there. Those are the big ones that come to mind.
Yeah, thank you so much for that. So we continue getting questions. We can get a question from the gentleman there.
Hello, my name is Karanja. I'm doing financial engineering. So my question is based on capital allocation. So could you shed light on EABL's capital allocation strategy when it comes to balancing investment when it comes to core brands versus new market opportunities?
Thank you, Karanja, for that. We're just off a detailed strategy process, and we do that every year where we size markets, we size the potential, we size what are the different categories. We look at trends, we look at consumer cohorts, we look at brands, and then we see what are the areas we can invest in, and then what are the priorities. So of course, when you then look at capital, we've got a bit of a prioritization process where we look at one, what's the size of the opportunity? And that looks at, is it a large part of the market? Is it growing? Can it make us money? And so we rank it according to that. And in that location, if it is in the 3 countries, how are the macros? Are they stable, progressive, or are they weak? And then we look at our ability to play. Do we have the right products? Do we have the right brands? Do we have the right people? Supply capacity? And once we've done that, we then say, these are the highest priorities for us. There are things that we will say, based on that, we don't want to play there. Yeah, but if we have a limited pool of funds to invest, this is where it's going too fast. And so that model factors in growth as well as size. And a lot of that growth is based on independent data, but also market studies of how our consumers are evolving. So it's quite an interesting process. And once we determine the priorities, we then look at how do we fund that and how do we prioritize the funding. But it's really based on the potential, the growth, the returns, and our ability to convert the opportunity.
Thank you so much. There was a question here.
Hi. My name is Harriet. I'm an FE student. I was looking at the sustainability reports, and I saw a lot of things. I saw that there's a program where educating people, like you've educated around 75,000, and there's a driving on the wrong side of the road program, 40,000 plus. I'm not sure. I can't remember the numbers there. Yeah. I also saw that other than that, because climate is economical, social, governmental, so there's, what else was there? Oh yeah, focusing on carbon and water. So for example, in Kenya, you've helped pump water for school. I can't remember where it was. Ruaka, somewhere close to Ruaka. Mm-hmm. Then there's a biomass plant that you've managed to build, yeah, and that has reduced carbon emissions. And I'm just seeing a growing trend, yeah? And I'm asking, what are the strategies that you've taken to maintain these programs, one, to improve in the sense of improving sustainability, and what was the opportunity cost of that? Like, what did you have to, in every decision there's something that there's a trade-off. So what was the trade-off in order to make that successful?
Thank you, Harriet. That's a really good question. And for us, given the industry we are in, and even if not, ESG is very critical and is core to our strategy. So if you see even our annual reports, when we put together our strategy, you'll see something called Society 2030, which is our ESG strategy. It has a number of pillars, 4 of them. The first one is inclusion and diversity, and that's cutting across gender, people who have less access to employment opportunities, so talking about youth, talking about people living with disabilities. So we have an inclusion and diversity pillar. Why is that important? In manufacturing, historically, because it was more brawn than brain, it was a historically male enterprise. And there's still sections where, particularly in the plant, where you don't have as many women. Similarly, with other STEM-related areas, you also in schools are not having women doing STEM products, so STEM subjects. So we think it's important that you reflect the face of the populations of the communities that you're in, and so giving more opportunities to women to participate in the workplace is important to us. We've got very progressive policies around things like parental leave, around work from home and things like that. So we are very, very progressive around inclusion and diversity. But it's also not just internally, it also goes down to our farmers. We work with a lot of farmers who are one female or living with disabilities as well. And that really cuts across how we operate, even in how we portray our marketing. We make sure that it is very, very inclusive. The second pillar is what you touched on, which is grain to glass sustainability. So making sure that our operations are conscious around our impact on the environment. So carbon, we're a big energy user. We used to use a lot of heavy fuel in our plants. Now we've replaced that with biomass in Kenya and Uganda. So we put out those plants back in 2020. They actually save us money from an operational OPEX perspective, but that wasn't just the intent. The intent is that by 2030 we want to be carbon neutral. We will be way before then, and through such investments. Under that, we also look at water. We use a lot of water in our production processes. Most of our cities are in water-stressed areas. So one, we look at how are we efficient, and we measure this in our use of water in the plant. Secondly, where we can recycle, do we recycle, use it for cleaning, use it for other stuff? Are we recycling that? But thirdly, are we going back into communities and giving them access to water and replenishing through trees and making sure we've got an ongoing program that is consistently working on that. So I could talk a lot more about that. There's a whole huge report that covers this. Of course, on the governance side, there's also doing business the right way is a big pillar for what we do. So I could say a lot more about that, but the reports are available. What is behind it and what's the trade-off? We're a 100-year-old company. We want to be here 100 years from now. And that can't happen if we destroy everything we meet. We have to be responsible citizens and make sure that we understand the impact on the environment and make sure also that we protect our consumers. You talked about the other pillar, which I haven't mentioned, which is championing responsible drinking. Our objective and the objective of our products is not to get everybody drunk and useless. Yeah, so it's making sure people understand, first, before you have a drink, what is it that you're taking? How should you take it properly? And if used properly and for the right purpose, then you will find that you drink less, but you drink better quality. So it's making sure people understand that the dangers of drunk driving, underage drinking, and we put in quite a lot of time into saying, we want you to use our products, but we want you to use it with knowledge and to use it properly. So that's important to us, because also we need our consumers to use this properly. And so ESG isn't just a tagline or a catchphrase for us. It's integral to everything that we do. And therefore, that is why it's built into our strategy. And we track it as we track financial performance. And we think that's important.
The expansion of the East African community by other member states joining in Somalia at a point this year, how is EABL assessing the other markets that they can join in and other markets they can venture in? Because a lot of the conversation today has been around Kenya, Uganda, and Tanzania, yet there's still other member states, DRC, Congo, Rwanda, and Burundi.
Thank you for your question, Keith. Definitely, that is on the radar, with or without them being on the East African community. Our core plants are in Kenya, Uganda, and Tanzania. Tanzania, we have 3 factories. Kenya, we have 3. One is a malting plant, 2 manufacturing beer and distilling spirits. And in Uganda, we have 1 plant. So that's where our physical premises are and plants are, and where we are our primary locations of business. However, we serve Rwanda, we serve Burundi, we serve South Sudan. All of those are quite big for us already, so we are already in there. We also evaluate every new market that comes. We do the same thing. We do consumer research. Who is there? What are they wanting? Are they viable? Can we go in and make sense? Does our footprint allow us to deliver there effectively and at a good cost? So all of that work is done, and then we get into prioritization. I think one of the gentlemen asked is, from a prioritization perspective, is the size of price big enough for us to go after it? Is the potential, and not just what is there we can make today, but in the future, does the size of price justify us going after it? Because often it means something else has to give. Or we have to go in and ask people for more money to go in there, and therefore it has to pay for itself. So there's quite an intensive process of thinking about that, evaluating, and then making the decisions to go in or not. So I think that is sort of the process we go through. I won't tell you we are going anywhere or not going anywhere, but that's the process we go through in determining where we focus. Yeah.
Great. I think we're making progress at the back there.
I have 2 more questions. So my question, the first one is, I'd like you to maybe contrast corporate finance versus the investing in Kenya for a financial professional. So I understand there's probably a lot of overlap, but then what do you think are the differences? Maybe what's more rewarding? Maybe the unique skills you would need. So working in maybe as a CFO or in core companies versus working in investment banking and the like. What do you think is the differences? And going forward, what do you think is better for us to pursue? And then maybe the second question would be, are there any opportunities you foresee at EABL for maybe financial economics, financial engineering, actuarial students? Thank you.
Thank you. Always. and a good question, really, really good question. I'll start with the first one. I think only you know what is good for you, right? Because after school, there's no who is number one, who is ahead of the other. Each one of you, when you live here, will have your path to follow. And that path depends on you being true to yourself. Do I know what I'm good at? Do I know what I enjoy? And therefore, I will thrive at doing it. Thriving at doing it or enjoying it doesn't mean it's easy. It means I'm willing to work 24/7 to grow in that area. But that's because I absolutely am passionate about it. It builds on my talents and my strengths, and therefore that's the way to go. I, in a controversial opinion, always say that joining audit firm was very important for me, because then I could see all of these different opportunities and decide which do I want to go for. So I'll know enough about banks, I'll know enough about investment banking, I'll know enough about insurance if I'm in actuarial, I'll know enough about manufacturing, I'll know about pensions, I'll know about development, I'll know about every industry by the time I'm done in an audit firm. And then from there I have a good base to say, this is what I really enjoy and what I really like and what I'm good at. And therefore, if I'm going to specialize, then I can go there with some good level of knowledge. Another route is through internships. So don't waste your holidays watching movies. Look for a role, even if it's unpaid. to start to experience different options for your career. And even then, when you come for an interview, and Michelle is here, she's the one who will tell you if she has jobs. Michelle will be looking out, and the people who will strike her are those who've done something with themselves beyond coming to class. What did you do? What opportunities did you take? And how do you make sure that in this sea of people, it is you who will be picked? One good way of doing that is by asking questions.
We are coming to the end, and I just want to pose the last question. If you look at EABL, it's a $1 billion market cap company. What would it take for it to double and triple so that we have a very big capital market with $2-3 billion capitalization?
I was hoping you wouldn't ask that question. I mean, it's obviously one that one would ask, and I'll still go back to, I wish I knew how our capital markets operate and how, the market cap movements are determined and the share prices. But I think for me, it's about, one, being very, very aware of our markets and our consumers. Where there's a consumer that's viable, profitable, as the gentleman asked, they should be drinking our product. If they choose to drink, they should drink our product. They should have access to it. It should be within their reach, and they should be able to get it. And so it's about really being close to consumers, being innovative, and that's where the microbrewery comes in, quickly testing, defining what works. If it doesn't work, throwing it out, and then moving real quickly to the next big opportunity. And then thirdly, I guess I shouldn't say this, but I will, that to double market cap, in a logical world, maybe an inorganic play would make sense, but there's no guarantee that that will double market cap, given the way that our market is currently not as responsive. I think over time, I still have confidence in our market. I do hold shares of various companies, and I do think in the long term, if you're doing this for the long term, it makes sense. So I would still be very keen on it. And I do hope that we will see that market cap double with time.
In the long term.
Thank you.
Thank you. So I want to appreciate the audience for coming in today for this show. We are very grateful. And we want to thank also the team from Strathmore, the SCVI, for making this show a success, and a special mention to Tanya Skipper for that. We want to thank our guest for coming in and sparing time to be with us today. And until next time, bye-bye.
Thank you.